second half outlook and the role the presidential election could play. Joining us now is John Lynch, Chief Investment Officer, Comerica Wealth Management. John, it is good to see you. So we did hear from Jay Powell today on Capitol Hill. Here's how Ian Shepherdson over at Pantheon Macroeconomics summed it up, John. He said, Mr. Powell remains reluctant to signal the onset of monetary easing well in advance, scarred, he says, by the burst of inflation in Q1. But reading between the lines, Ian says, we think his base case is a September easing. Does that sound right to you, John?
Good afternoon, Josh. Yes, I think Chair Powell not only scarred by inflation from the past couple of years, but inflation in the late 70s and early 1980s, right? He doesn't want to make that mistake of the Burns Fed. But I do think Julie mentioned earlier that he was inching towards a hike, and I thought that was towards a cut. And I think that's a perfect description. I do think the Fed will cut in September. We've seen weakness in ISM manufacturing. We've seen weakness in housing. And now we're starting to see cracks in the labor market. For 3 years, we've spoken solely of a single mandate for the Fed. And now we're finally seeing the second mandate, which really gives them the 1-2 punch to be able to cut in September.
So what does that setup imply then for stocks here? I mean, as I mentioned, it feels like another day, another record. You kind of shrug at this point, but we're there. We have been seeing quite strong performance, even if it's small every day, for the stock market. Does that continue?
I'm not sure. I think we have to see is more clarity from the Fed, more clarity from the data. This is a big month. We had obviously the jobs report. We have second quarter earnings. We have the Fed meeting at the end of the month. And then Thursday's CPI report. So I don't think you're going to see as much as you would from, what we used to call the Humphreys-Hawkins testimony, right? The 8 pressers after each Fed meeting is certainly more important, I think, than the congressional testimony today, this week. So I do think, Julie, that, we're going to see a cut in September, a cut in December as well. But after that, that's what the market has to figure out. I'm not convinced we really want to see more cuts, because to the degree we're able to get the federal funds rate more in line with nominal GDP growth, if you want to think about 3% inflation, 2% GDP, if we get the federal funds rate in that 4.75 to 5% range, that's probably as good as it gets. So it's really going to come down to earnings as opposed to the Federal Reserve as to whether or not this market can keep climbing.
So let's talk about earnings, John. I'm just curious, what are your expectations for corporate profit growth, not just this earnings season, but for the year, John?
I think the most important thing for this earnings season, really, frankly, I don't care whether they do 8.5 or 9.5% earnings growth for the second quarter for the S&P 500. I'm more interested in what companies say about the second half of the year. We're looking at about, again, 8 or 9% for the third quarter. But the big number is the fourth quarter. Consensus estimates 17, 18% year over year in the fourth quarter. I'm really hard pressed to see that number. So specifically to your question, I'm below consensus for this year. I'm at 237.50 in operating earnings. The street's about 245. I'm really hopeful that we get good clarity on guidance for the fourth quarter and, frankly, the first half of next year, the first quarter of next year at a minimum, at which point that would make me more bullish on earnings. The street's at maybe 275 next year. I'm at 260. We're at 5,500. A lot of good things have to happen now fundamentally, now that we've done so well technically. And I'm not convinced that earnings will be as high as the consensus currently anticipates.
What about sort of historical trends as well here, John? Because there's two things potentially moving in the market's favor on that front. One is that we saw the S&P 500 gain almost 15% in the first 6 months of the year. It tends to do well in the second half when it's had gains of at least 10% in the first half. And secondly, it's a presidential election year. And we also tend to see some gains for stocks accelerating in the second half of the year in presidential year. So what then do you do with that?
Yeah, technically, it's a beautiful market. We've seen 5,500. Once we broke through 5,250, our technical target was 5,550. We were able to achieve that, but the math has to work for fundamentally for that number to be justified. But technically, to your point, looking at the first half of the year, north of 10%, we identified 10 times in the past 30 years where we've had a 10% plus gain. And in the second half of the year, we had a similar outcome. So that bodes very well. As much as I'd love to see 6,000 on the S&P, I want to make sure, earnings can justify it. And to your point about the election year, I think it'll be really important for investors to focus on what the market does the 90 days from August 1st to November 1st, because more often than not, that is the true indicator as to whether or not the incumbent or the challenger is victorious. The market's down, the incumbent party or incumbent president tends to lose. If the market is up during that period, you tend to see a different outcome.
John, add it up for us. Give us the bottom line here, for investors who are listening. How do I want to be positioned in this stock market, John? What are the sectors that look attractive to you?
Yeah, bottom line right now, 55.50 on the S&P, a really good number technically. What we're looking at sector-wise, we want exposure, obviously, in technology and communication services. But I really want to see particularly new money coming in on a more balanced basis. Don't jump all in at once. Look for equal weighted S&P type performance. We're starting to see some traction, but it's been lagging to an extreme. So I think that bodes well for a broadening out of participation. So, for example, post-debate, we saw energy and financials start to do a little better. And I think that's really a reflection of a market voting and saying, okay, maybe it'll be a less burdensome regulatory environment. So try to barbell the risk, if you will, between what we're seeing on the runaway train from technology and communication services, but find some of those, financials and energy to balance out a portfolio.
John, good to see you. Thanks for joining us.
Thank you, Julie.